Good evening. Welcome everyone to our webinar here at Admiral Markets. Glad that you could join us today on the Thursday, the 5th of September. We're going to take a look at risk management today. So that's going to be an interesting topic, especially if you look at the environment we are in today with a lot of interest rates and NFP. So I think it's well worth looking at risk. Before we do that, we are going to take a look at this introduction. Of course, as always, looking at the risk disclaimer. Before we do that, though, I want to show you this slide with the nice spreads that you can find at Admiral Markets. So I do highly encourage you to, after the webinar is over, to take a look at the spreads that you can find on the website and download a demo to see that in real life. As always, I should warn you that the risk disclaimer, please read the entire disclaimer. But at minimum, you should be aware that trading foreign exchange in global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this video and webinar is for educational purposes only. So I thank you for your attention on that. And I think Michael is here today to share a few words with us.
Thank you very much, Chris, for this lovely introduction. We are going to talk about risk management a little bit later, but before that, I wanted to talk to you about a few things that I think are very important. First of all, it's very nice to talk to such a large audience today. Very nice. My name is Mikhail Olachov, and I'm a client relationship manager for Admiral Markets. Here's my name. You can always Google it to find me on LinkedIn and add me as a connection. I'll highly appreciate it. My email address, my phone number, and Skype. Any questions you might have, please don't hesitate to contact me. I'll be more than happy to help you out with whatever issues you might have. It's incredible to speak to such a terrific audience today. We have a lot of people participating in those webinars, both webinars and live sessions. I see that some of you are just making your first step in Forex. Some of you have already trading with Admiral Markets. Some of you have demo accounts. Some of you have real accounts. And of course, some of you have real accounts with other brokers. And today I wanted to talk to something that applies to every single one of us at some point of time when you are choosing the correct broker. I wanted to speak about this. Why do we choose one broker over the other? What sets apart one broker from the rest? There are a number of factors you consider before you make a decision, and I wanted to speak to you about all those factors one by one. First of all, you will probably consider the spread, the platform, deposit methods, amount of instruments you can trade, variety of account types, and so on and so forth. You choose the factors that are most important to you, and then you make a weighted decision. But of course, none of those factors matter if the key factor is missing. I'm pretty sure that all of you guessed it already. It's not on this table, and this factor is, of course, trust. No matter how great the conditions are, it all means nothing, absolutely nothing, if you don't have the trust in your broker. In fact, none of those factors even exist if you do not trust the broker who advertises them. Just think about it. Investment is a very, very difficult, very tricky subject, and of course you want to be 100% sure in an organization, in an institution that handles your funds. Now, if a broker with a dodgy reputation advertised 1 pip as spread, would you believe him? Of course not. No, most likely the spreads are higher, and even if they were that low, you would not probably be able to withdraw your profit at the end. So you see, the trust is the main factor. In fact, you must be able to trust the broker as much as this guy trusts this guy, because of course you're not entrusting the broker with your life, but you do entrust your broker with your funds. So the trust, I think, is the most important criteria. And trust has been a critical issue, especially in the financial industry for the past few years. And if you would never buy a product on eBay from a seller that has less than 100% positive feedback, Now, why would you settle for anything less when it comes to a broker? After all, you entrust your broker with a substantial funds, and the level of trust should also be substantial. So, how do you choose a trustworthy broker? As you see on this caricature, there's a bunch of people with long noses telling you all those little porcupines and lies. How do you choose a broker that is going to be fair and is going to stand by you, is going to honor his word? I'm going to talk about those factors, and I'm going to help you choose a correct broker. As most of you have probably heard and noticed, there is not a single place on the internet that will present you with 100% accurate data. And more often than not, broker ratings on all those websites, they really depend on the amount of money said broker is willing to pay to the website. So here are a few things to look at before you choose a correct broker. First of all, in the financial world, there's always someone watching. In this case, I'm talking about the regulators, of course. In order to receive your license, you must comply with strict regulations. And more regulators you allow to watch you closely, more secure you are. Admiral Markets, for example, is licensed by European Union by EFCA and has obtained a passport from MiFID. Admiral Markets has recently received an FCA license in UK, quite difficult to get this one, and we have been licensed by Australian Financial Service License for a few years now. But being licensed, of course, is important. Yes, it is very important. But Admiral Markets is not the only broker that is highly regulated on a number of continents. This is why we decided to go further. In a Facebook era, we at Admiral Markets decided that just not enough to be just a regular broker. We wanted to go further. And rather than sharing a transaction with you, we want to establish a personal relationship with all our clients. Our policy is to provide a personal account manager to each of our customers. If you have a real account with us, if you have a demo account, or you participate in the Forex Bowl, there is always a person in our company that can help you out in your own language. Not a member of a support team, an actual person that is responsible for your account from the time you registered in a company to the time you decided to withdraw all your profits. In essence, this is our, personal relationship is something that we really are keen on in Admiral Markets quite a lot. So in essence, our size is something like this, a size of a huge shopping mall. We have offices in 40 different countries all over the world, but we want our customer service to be something like this, to be on a level of a small grocery shop on a corner or a local barber that has known you since you were 6. This is a customer service, the level of customer service we are trying to go for in Admiral Markets. And I think that I'm actually quite a great example, because I work with clients in UK and Ireland and Western Europe, and if you're watching this webinar from one of those countries, chances are me and you have already spoken. And at the start of the presentation, I have shared my email and phone with you. Here's also my Skype and LinkedIn. So you can actually, at any time of the day, Skype me or send me a message on LinkedIn. You know my career details and everything like this. It already feels like we have known each other for at least some time. And all of our customer relationship managers in Admiral Markets would be absolutely happy to do the same. So we at Admiral Markets believe that in the modern era, trust is the main virtual currency. We conduct our business in an open and friendly manner, and before we get it, before you get your business, we are ready to establish a relationship with you. So once you feel we have won your trust, you can register an account, and you will find out that our spread on major pairs is as low as 1 pip during the daytime. We offer MetaTrader 4 and 5. We accept bank wire payments, card payments, and Skrill. We give you a variety of accounts to choose from, standard, professional, all sorts of managed accounts, and special CFD account as well. So register an account today once you have finished with once you're finished with this webinar, and you can meet your personal account manager in just a few hours after that. To him, you will always be a #1 most important client. So If you have any questions, I'm always available on all communication means. Please don't hesitate to contact me. And I will now be passing the microphone to Chris. I hope all of you are eager to learn new things, and I'm pretty sure Chris will teach you a lot of them. Thank you very much.
Oh, that's great. Thank you so much, Michal, for that great introduction here on trading with the admiral markets. So with that said, we're going to take a look at today's goal of the webinar here, risk management. But beyond risk management, we're going to take a look at the risk of ruin table, the technical, psychological part of it, choices in risk management, ratios, and all that. So there's a lot of good things yet to come. So sit tight, grab a cup of coffee, because I think you're going to enjoy it a lot. What is risk management? Well, we're going to start off with a quick explanation from my side, and then Tarantula is going to share his view on that. But basically, it's just a method to control the risk exposure when in the market in general and when trading. Okay, so it's just a way of controlling our risk when trading, pure and simple. Now, for Forex trading, because we do have a leverage, it is very important because we're using a trading capital, a margin, so we want to make sure that we still have that trading capital at the end of the day. So our goal is to protect that trading capital so that we can continue with trading the next week, the next month, and the next year, and decade for that matter. So that's very important, and without risk management, we're basically risking that entire trading capital and in risk of getting a margin call. So in that regard, risk management, in my opinion, is more like a foundation of trading. It's kind of like the base. It's the foundation of a house. So if you see yourself picturing someone building a house or yourself building a house, the first thing you start with is the foundation layers. Then you start building the walls and the roof and the internal stuff. So the risk management, in my opinion, is that base. And the trading strategies and the money management, trading psychology are the walls and everything else that you put on the base. So basically, with that in place, we're limiting our exposure, our loss for any one trade, for any particular group of trades that we have at any particular point in time. For example, we could limit that risk to 1 or 2% of our trading capital as a fixed percentage of our trading capital. I also hear a bit of echo. I think that T, maybe, would it help if you have, yeah, that's a bit better indeed. Good. Well, anyhow, I've almost finished with my part. I just wanted to say that, with that in mind, you cannot lose more than 1 or 2% with your trading capital, and that will limit your loss. So in that regard, risk management can be quite simple. If you just limit your loss to 1 or 2%, or let's say max 5 is really the max. Most people and traders advise 1 to 2%. Some say not more than 5 if you feel that the trade is very good. And if you're risking 10, that's already on a very, very high side, and that's in danger of losing your capital if you have a losing streak. So it could be that simple. But we're going to dive into more aspects and some interesting stuff that you could work on to expand that risk management side.
So, yeah, Chris, I think that you are right. So, guys, I think that this webinar today is very important for your understanding, because you can have a good trading strategy which yields you and gives you 60 to 40 win-to-loss ratio, but without a good risk management, you're at loss. Even if your system or trading strategy is not so successful, with proper risk management, you will preserve your capital and you will earn. You will not earn a lot, but you will still earn. So for me, risk management is the most important factor in Forex trading. I will also give you a quick introduction of my views, what is risk management, and basically all associated risks. So risk management is the identification, assessment, and prioritization of risks. So you need to prioritize the risk, you know, to identify the risk, and you need to know what to do if that happens. There are two basic, and there are two simple things for risk. Those are technical risk and psychological risk. I will explain everything. Risk management differs from forex gambling, and I will tell you that speculating as a trader, that means you're not gambling. And I have heard many times, especially some of my friends tell me, always telling me that that I'm a sort of a gambler and that forex market is gambling. And now let's be clear once and for all. Forex is not gambling, and I will tell you why it's not gambling. So you will need, and you will know the clear answer to anyone who tells you that forex is gambling. The main difference between gambling and speculating, and by speculating I mean trading forex market from now on, that is risk management. So the difference between gambling and speculating is risk management. And in other words, with speculating you have some kind of control over your risk, whereas with gambling you don't. So even a card game, no matter what, can be played with either the mindset of a gambler or with the mindset of a speculator, and usually with totally different outcomes. So risk management is all about keeping your risk under control. The more controlled your risk is, the more flexible you can be when you need to be. Forex trading is about opportunity. So traders need to be able to act when those opportunities arise, and that means reaction. I always say, not prediction, reaction. By limiting your risk, you ensure that you will be able to continue to trade when things do not go as planned, and you will always be ready. That is not possible with gambling. So with proper risk management, even if your trade don't go as planned, you will be ready to know what to do and not to lose much. Using proper risk management can be the difference between, and there is a difference between becoming a forex professional or being a quick blip on the chart. And many traders are quick blip on the chart. So risk management is crucial for success in forex trading. It's the most crucial. Forget about trading strategies, forget about systems. Concentrate on your psychology, on your technical and psychological views. So it's the crucial. If you see forex market as a gamble, you don't understand it from the professional view. So leave the forex alone. You are not for this market. You need to take your step and mindset further. Being an average trader is not enough. Why? Because if you are an average trader, you will become drowned in the sea of average traders. So you will earn, you will lose, maybe you will, and mostly you will lose more than you earn, and eventually your account balance will be empty. So you don't have the money. You won't have the money for trading. You need to jump from those average Joes. So I'm not talking that each one of you needs to become a professional trader that belongs in 5% of top traders. No, you don't have to. You just need to be above average to have 60-40 or 70-30% chance for winning, and by deploying a good risk management, you will be profitable. So you can have those 2, 3 to 10% per month constantly. So even if you don't make that money, at least you know that you can pull out of losing streak. So you won't get into a death spiral that will doom your career as forex trader. So with proper risk management, you can rise as a phoenix, and you can start again. Without that, it's impossible. No matter how good your trading strategy is, no matter how good your money management is, risk management is the core of being a professional trader. Now I will show you.
Absolutely.
You agree with me, Chris? Yeah. So this is risk of
ruin,
and Chris, please explain that. This is also very important.
Yes, definitely very important indeed. Just to give you an idea how much, risk or the risk of basically losing your capital at certain percentages that you choose. So for example, if you're risking a standard 10% of your capital, 1/10, then what happens if your win ratio is 25%? Okay, so here you have the win ratio on the left. And that varies, that's just an example, from 25 to 60. And these percentages indicate basically the probability of losing the equity. So you can see that if you're risking 10%, that at these levels, there's a very high level of risk that you will lose that equity. And this is at the top is the payoff ratio. Now, of course, the higher the payoff ratio, the reward to risk basically, the less win percentage you do need to mitigate and defer that risk that you will lose that entire capital. But obviously, even a 13% chance, in my opinion, is quite high. So that's with 10%. But the funny thing is that if you look at the 10%, that 2%, and compare that to 10% with the starting account of 5,000, you quickly see that 17% of the account has been lost if you have 10 losses in a row. And it doesn't necessarily have to be 10 losses in a row. It could be 5 losses, 2 break-evens, a win, and then another 5 losses. That more or less would have the same effect. And if you would risk 10%, it would be over 60%. Now, not only that, but to gain back the 60% loss, after you have lost 60%, you have 40% left, means that to go back to the initial balance of 100%, you don't need to, 60% would not be enough to get you back to 100%. No. You need to, let's see, 1.5 times that amount you need to go back to 100%. So that's 150% profit to go back to 100%. So when you lose 60%, gaining 60% is not going to get you back to break even, right? So that's quite a quicksand there with this risk of ruin table. So good to know, and definitely want you to know about that. Probably, maybe some of you do. And we'll take a look at that, your question, Ashish, just a bit later. After the webinar, you can ask any questions you want. So this is the technical part, right here.
Yeah, the technical part, and I will tell you about technical and psychological part, and that is how you can do risk management practically. So now you should listen to this. This is very, very important. The first thing, so these things are not from 1st to 10. These are all equally important. So let's start with increase the odds, technical analysis. What does it mean? The first rule in the risk management is to calculate the odds of your trade being successful. So to do that, you need to grasp both fundamental and technical analysis. Since we are talking now about technical risk, technical part of risk management, we will talk about technical analysis. The first thing is that you will need to understand the dynamics of the market in which you are trading, and also know where likely psychological price trigger points are. For example, with a price chart that can help you decide. So once you made your decision to trade, the next important factor is how you control or manage the risk. Remember, if you can measure the risk, you can, for the most part, manage it. So if you remember one of our first webinars and my personal webinar about technical analysis is again something that differs you from gamblers. Why? Because if you do it, you stack the odds in your favor. So let's say that you are entering in the market with 50-50% chance of winning. It's 50-50. Casino is less. Casino is 30-70 for the casino. So by entering the Forex market, it's 50-50. By doing great technical analysis, you stack your odds to 60-40, even 65-40. So in stacking the odds in your favor by doing a good technical analysis, it's important to draw a line in the sand. which will be your cutout point if the market trades to that level. And the difference between that cutout point and when you enter the market is your risk. Psychologically, you must accept the risk up front before you even take the trade. So you need to accept the risk even before you can even take the trade. You don't enter Forex market with saying I will earn 100%, I won't lose, this is good, I can earn money wherever I want to. No. First you need to accept the risk, then after accepting the risk you enter the market. And then after that you do your technical analysis. Of course you won't do live trading before doing demo trading. So you need to know technical analysis prior to your live trading. That is a part of risk management. Second point, market liquidity. Liquidity means that there are sufficient number of buyers and sellers at current prices to easily and efficiently take your trade in your desired direction. In the case of the Forex markets, liquidity, at least in the major currencies, is never a problem. So this liquidity is known as market liquidity, and in the Forex market, as a spot cash market, it accounts for some 2 trillion per day in trading volume. Also, when there is no liquidity, you don't trade. So now you will ask me, when is that there is no liquidity? Well, that is, for example, yesterday. No, yesterday. Well, last first 2 days of this week. Why? Because the market has been waiting. The first day was Monday. Monday it was a bank holiday. There was no liquidity. There was no liquidity. Why would I trade if there is no liquidity? Then yet again yesterday, well, okay, some liquidity, but again, when big news big news are what we are waiting for, market liquidity will drop and it will rise after the news and just prior to news. So you can trade, you can scalp a little if you want, but market liquidity is the very big risk factor. So I always say, when there is bank holiday day, don't trade. When there are many bank holidays, you shouldn't even open the platform. When there are news that market is waiting for, you see that liquidity is low and news, all that's been waiting for is the news, so you wait for the market. You don't chase the market. Let the market run to you. Don't chase it. The third aspect is determined by how much trading capital you have available. Risk-based trade should always be a small percentage of your total capital. A good starting percentage could be 2 or 3% of your available trading capital. So let's say that you have $5,000 in your account. So the maximum loss available should be no more than 2 or 3%. With these parameters, your maximum loss will at least exceed $100 per trade. And let's say 2% loss per trade would mean that you can be wrong 50 times in a row before you wipe out your account. Well, now imagine, is this likely scenario that can happen? Well, to be wrong 50 times in a row, I have never heard of that thing. Maybe there are some wannabe traders, or I don't know, well, who trade with that kind of losing streak, but that is really unlikely scenario. So if you have a proper system for stacking the odds in your favor. So now you see how those theses are linked. Risk per trade, market liquidity, technical analysis. Now you're stacking the odds in your favor. 1%, 2%. Well, now you're above 50%. Now you're above 60%. Leverage. What is leverage? Another technical aspect of risk management. It's the risk magnifier. Leverage is the use of the bank's or broker's money rather than the strict use of your own. Spot cash Forex market, as you know, is a very leveraged market, that you could put a deposit of just $1,000 to actually trade $100,000. This is standard 100 to 1 leverage factor. 1 pip loss in 100 to 1 leverage factor is equal to $10. So if you had 10 mini lots in the trade and you lost 50 pips, your loss would be 500, not 50. So again, well, leverage. You know, we had webinars about leverage, about money management. Use the leverage to your advantage. Don't use it as a magnifier to your risk. Lower the risk by using proper leverage. Now again, you got some 2%, 3% of stacking the odds in your favor. Now odds are above maybe 65%. Well, now we are coming basically to that level of 70%. 80 is very hard to achieve, but let's talk about exposure. Now, what is exposure? Well, reducing lot size is a good thing. But yet again, it will not help you very much if you open too many lots. So that is called exposure. It's also important to understand correlation between currency pairs. For example, if you go short on euro dollar and you go long on Swissy dollar, dollar Swiss, well, you're exposed 2 times to dollar currency and in the same direction. So it equates to being long 2 lots of dollar, right? So if the dollar goes down, you have a double dose of pain. That is called double exposure. Keeping your overall exposure limited, it will reduce your risk and keep you in the game for the long haul. So basically, what you shouldn't do is to double expose yourself. So if you go short on euro dollar and long on dollar Swissy, what you do, you basically kind of hedge your position, right? So what does it mean? Well, you have exposed basically 2 times to dollar. Well, maybe if correlation is negative, well, then your 2 trades will go bad. If dollar goes down and correlation is negative, you have a double dose of pain. So that is called exposure. If you trade dollar crosses, be aware of that. Be aware of correlation between currency pairs. Next thing is scalping. Well, you know what scalping is. We had a webinar about it, and well, if you want to scalp, you can just pick an arbitrary direction and put a large trade. So that is, if you do that, that is what we traders call trade and pray. And if you are doing that, it's only a matter of time before you end up laying by the wayside with an empty trading account. There is an old adage, the old saying, I think it goes, you can try to scalp the Forex market, but, well, Forex market will eventually scalp you. So scalping seems fun when you're winning, but as soon as you start losing, it's not fun anymore. It's human nature. You want to feel smarter than the market. Well, the truth is that the market is just the market, and all we can do is follow it. There really isn't be the market method. So you need to trade small, right? You need to trade small. I know that it's tempting to trade big for fast money, but it's definitely road to ruins. We talked about it. You need to trade small. So if you don't know how to scalp, don't do it. If you are a very good scalper, then you can do it, but being a very good scalper stacks odds into your favor. Being a bad scalper, again, will stack the odds in your favor if you don't scalp the market, right? Now scalping, I know that many of us scalp. I scalp a lot, but I know how to do it. If you're not sure how to do it, well, don't do it. Trade with stops. Scalping can easily go wrong. Set a stop that is your maximum loss and leave it alone. If you get stopped out, well, then accept the loss and move on. You need to learn to trade. Well, now, you cannot make the money only by scalping. So, that is maybe that sounds funny, but you know, trend following, counter trend trades, breakout trades, and scalping. These are all factors which determine you as a trader, right? So, well, I will tell you now. Maybe it's funny to you, but overall scalping is not a viable trading method for overall profits. It's viable only if it's used in combination with other methods. If you don't know what you other methods of trading, then learn to trade Forex first. So that is very important, because many newbie traders start with scalping and think they can make money. You need to know counter trend. You need to know again. You need to know trend or counter trend or breakout trading. All what we were talking about. Purely scalping is not enough. Now trend or counter trend. Well, that is another good thing. Determine what kind of trader you are. So you can trade a trend, you can be a trend follower, you can be a counter trend trader, but you can be both. But then again, it needs a practice. You need really a lot of practice. I'm better trend follower, trend trader than I'm a counter trend trader, but it doesn't mean that I can not pick a good counter trend trade, right? But if you're not sure, stick with the trend, because the first part of learning Forex is to be a trend trader. Then after you have mastered that, then you can be a counter trend trader. Vice versa, it's well, I can say that this is basically impossible. And then yet again, risk to reward ratio. If your risk to reward ratio is good, let's say 1 to 2, 1 to 1 to 1 to, let's say 1 to 2, or 1 to 1.5, or 1 to 3, which is hard in today's market conditions, well, then yet again, you are stacking a big odds to your favor that can raise about 75% of success. Risk to reward. But yet again, this is all technical part, and this goes with psychological part. So it cannot be, I have made it simple, technical and psychological, but it goes together. They cannot be divided. Technical and psychological part make a risk management such as this, a pure risk management. So the last thing is risk to reward ratio. If you know how to make your risk to reward above 1 to 1, you are on a good way to becoming a good trader. So let's sum it up. Technical analysis, market liquidity, risk per trade, leverage, tracking overall exposure, understanding stop loss, scalping, trend or counter trend, risk to reward. It can give you 70 to 30, close to 75-30. If these all theses, these all points are correctly applied. And don't forget it, we still have to cover psychological part. Without psychological part, this means nothing.
Great stuff there, Tarantula. And in fact, I wanted to suggest, before you go into the psychological part, I had a few slides here regarding maybe more technical than psychological. So I'll do that first, and we'll continue with the second part. One thing, now this is maybe getting into details, but one thing that I was looking at in the past was also very intensively into whether you want to take risk always at the same level, or do you want to vary that risk. So some people are very pro a fixed risk at all times, and it does have advantages in the sense that you always will play out your advantage with equal risk. So if you have a statistical odds that say 60-40 with a 1.3 to R2R, then if you apply the same risk overall, then you should be profitable. Now, if you vary that risk, of course, you might be taking more risk on losing trades and less risk on winning trades, which would skew and change that configuration. So there's a lot to say for using fixed risk levels. There's also people who use varying risk levels depending on the trading strategy, the particular setup, maybe the entry methodology, or they split their risk into different entry methodologies, saying, okay, I'll take a part risk at this level, but if I get a candlestick confirmation pattern, I'll add a risk element or addition, And if we break a trend line, I'll add the last part, scaling in, for example. That itself is also another topic and not the easiest method to implement, but that's one of the options that you can think of with varying the risk. Or the economic calendar. For example, we have NFP. Do you want to risk an NFP or not at all? Do you feel comfortable with that, etc.? So if you decide not to trade at NFP, then that you're in fact saying zero risk at that day, or I'm only trading with a quarter of the risk, etc. So besides that, point 2, and I have it actually, point 1, I'll dive into a bit more what I did in the past. I don't use that actively, but maybe you can use it, maybe you find it interesting. I'll show you that matrix I used for that risk management in just a second. Point 2, methods of risk management. You want to identify for yourself in your trading plan, in the risk management section of your trading plan, what is your maximum risk per trade percentage? What is your maximum risk percentage per open trades, per pending trades? Maybe you don't have that, but if you say, I don't want more than 5% open, well, not per trade, let's say I don't want more than 2% per trade, but in total, not more than 5% or 4%, and pending trades not more than 2. Because if you have pending open, then those could be triggered, right? So something you want to think about maybe as well. Or what is your maximum risk per open and break-even trades? What is your maximum risk percentage per day, per session, per week, per month, maybe even per quarter? I don't know. That's maybe going too far, but you get the point. Maybe you want a maximum number of trades per open, taken, and pending. What is your desired or preferred risk levels? Maybe instead of maximum risk levels, you want to talk about preferred risk levels instead of max. Maybe a profit target could be good per session, day, week, month to reduce the psychological risk, because maybe if you're up in profit, you have the tendency to start risking more and giving back that profit to the market. So if you have a certain target in mind, that's also a risk management, because then you keep the profit, which is definitely more than half the battle, because without taking profit, it's difficult to compensate the losses and actually make money, right? So maybe you want to only trade a maximum number of currencies, or have only a number of currencies in open trades, or how about currency cross correlations, as already Tarantula was talking about. So I myself, for example, typically trade between 0.5% and 2%, and don't want more than, depends on which type of strategies I have open, because sometimes I have intraday and swing trades at the same time. But intraday trading, I typically don't want more than 2% open. That would be my desired level. And swing trading, 3%. And it doesn't necessarily have to mean that that percentage, all that percentage is open and used at every single point in time. I'm talking about a desired level I don't want to cross, so when placing pending orders, I'll keep an eye on that. Let me show you a management matrix that I used in the past. So you can, for example, choose a standard risk level percentage for the per trade or day. And what you can do is define how risky a month is, a week, and a day. And if you want, also define the risk per strategy, entry method, filters, type, and quality of opportunity. That's point 3. So I'm talking about point 2 and 3. Point 2 is really looking at the schedule of the market and the time frames and altering the risk to that. Step 3, point 3, is more looking at trading strategy parameters and stuff like that. So for example, entries, trends, is it a counter trend? You might want to risk less. Is it a with the trend? You might want to risk more. Maybe you already do that automatically and intuitively. What do you think of the opportunity? Does it look good? Do you see things that are not so good? Maybe some price action. So that is more difficult though.
Well, let's say, Chris, that this is all what we are talking about, the technical part, and those technical parts are maybe I can say easier to master than psychological part, because let's say that we are all human beings, and such as being a human beings, well, we all have emotions, and their emotions, if not are tamed properly, can lead us to ruin. And that is why I really put an accent on that psychological thing. I really am, I think that I'm a good technical analysis and trader, but I really, really needed to work when I started trading live accounts, not demo accounts, on my psychology. And that is what I know. I know what is when you fight with yourself, and eventually when you stand up as a winner, then you can say, I will be a good trader and I can make a living from it. That is something that I needed just to add, but you can continue with your presentation. Don't worry.
Yeah. We'll dive into that a bit later on.
Yeah, it's very, very important.
Yeah, we're going to have, I suggest actually having a separate topic on that regarding trading psychology, because someone asked for that, and I think it makes a lot of sense. So I would suggest that we can talk about it later on, but I think that if people would be interested in that, having a separate webinar on trading psychology would also make a lot of sense. So the thing is here is just a very, this very precise way of analyzing how you can quantify risk. If you think January and December are higher risk, which they probably are, you can give that a number. And I'll show you an example here. Risk manager schedule. So, for example, January, 50 to 80%. June, green, 100%. Maybe in February you want to risk a bit more, or March, because those are better months maybe. July, August, less risk. December, less risk. So those are codes and percentages that reduce the risk you want to take in those months. But also the week itself, that's on the right side here, right? But also the week itself, you can give a certain risk. If it's NFP, for example, you can reduce that risk. You can even give a certain percentage to the day. Mondays and Fridays are more risky than Tuesdays and Wednesdays and Thursdays, right? And you can even give risk to sessions like that, right? If you do that and you say you take a standard risk of 2%, June is 100, Monday is 80, and the London session, that particular session, depending on the economic calendar that you can define, right? You can define it per session that you want to. You can do 2 times 1 times 0.8, because that's 80%, times 0.6, and you get close to 1% desired risk level for that particular session. But combining the risk parameters you find important for the month, day, week, and session. Okay? Good. Some risk management ratios quickly. Now, the drawdown, most of you should know that. It's important to realize what it is. It's just the peak to valley in our equity. So how much do you lose in one shot from your top to the bottom? Everyone should know that. Very important risk management ratio. If you don't know that, it looks a bit funny. If people talk about it, then you don't know it. It's really something you need to know, and probably you do, right? So you have an upside and you have a downside. How much is that in one shot downside before you go up again? It's like a retracement. We need to know how much that retracement is. We need to minimize the monthly loss and drawdown. Why is that important to know what our lowest monthly losses, or biggest monthly losses? Because investors, and you are the investor in yourself, and maybe you're trading with other people's money. You need to know that because of the risk. Every investor wants to know what is what I can lose in the month maximum, and what is the drawdown, and how much can I be potentially winning. That ratio is important because step 3, if you make 10% profit but you have a 50% drawdown, that's bad. But if you make 5% profit but a 3% drawdown, it's great. So although you're winning only 5 and not 10, the drawdown levels skew the investor's interest in the 5%, and almost everyone I know would choose the 5% profit above the 10% profit if the drawdown is that drastically less. You also have to know your average win versus your average loss and what your win-loss ratio is. Those are just basic risk management ratios, or even money management ratios maybe. More advanced ratios are, for example, the Sharpe ratio. That is often used, and something you should be aware of at least. At least the ratios themselves, that you know them, is good to know. And maybe you already know them, that's great. But it's good to be aware of those. Okay, Sharpe ratio is just an indication to measure the risk-adjusted performance. We can, as I said, we can get a great return. But if we're taking a lot of risk, it doesn't say much about our trading, right? Because we just took a lot of risk and we're lucky. If, however, you make a good return, not based on a lot of risk, that is not luck, but performance, good trading performance, smart investment decisions or trading decisions. So you can see that is the expected return minus the risk-free rate, like a US bond, for example, divided by the standard deviation. And that standard deviation is just a method of explaining how much do you usually navigate from the average. The Calmer ratio is taking the rate of return. So, for example, let's say someone made 10%, and dividing that by peak to valley drawdown, which could be 5. Okay, for example, it's just an example. So that's the equation here to get the Calmer ratio, and it's just a good indication of that same Sharpe in a way. Okay, to see, for example, if you have a drawdown of 20, but you have an R2R of 10, that is a lot worse than getting 5% but only having a drawdown of 2, right? Because that's 2.5. Anything about 1 or higher is already great, let alone if you get 2. That would be through the roof. Stable forward anxiety index just takes all your R2Rs, or rate of returns, in 1 month, but then divides that by the negative months. So let's say you made 40% in a year, and you had 2 months that had -4. So you have -8 in total. So you divide 40 by -8, which is -5. Okay. And the Sterling is something similar to the Sharpe and Calmer, trying to identify the same thing. Saturno as well, but the difference is that it only looks at the deviation of the negative asset return. So what it says is basically, I don't care if I have a lot of deviation on the positive side. If I make +10 one time and +1, I don't care, as long as the deviation on the negative side isn't too much. And it makes sense. That's a good alternative. And the standard deviation, last but not least, is basically how much variation is there from the average. Very important statistic. Our last slide on risk management within the Elliott wave, and we're going to go over to the psychology part and finish this technical part. And within the Elliott wave theory, basically it's a complicated diagram maybe with all these lines, but the green lines are price basically and red lines. And what you want to do with wave 1 is basically you want to risk about 60% on wave 1, the full amount on wave 3 because those are the best, and then about 30% on wave 5, right? Preferably no risk on corrective structures, although wave A and C, if they are impulsive, you could risk about 30 as well, up to 50 maybe, depending, maybe 30 on the wave A and 50 on the wave C. So that's just a quick explanation on how you can vary risk within every wave to optimize and capitalize on the more impulsive parts of the currency and risk less when there's a correction going on. Very important for allied waivers. That's it from my side here.
Now, guys, yeah, very good stuff. You got it into details, Chris. It was nice to hear that all those ratios. I don't deal with them much, but basically it's good to know a few things about that, really. What I wanted to say now, we are going to second part of risk management, and it's the psychological part of risk management, which maybe is the hardest part to overcome for most of Forex traders. Yet again, I need to express that psychologically you should be very stable. Technically, you might be very good and with all technical stuff, but if you're psychologically not stable, you will fail. And that is for sure. Believe me, there will be a point in your trading career where you will fail. So we all need to strive, and we all need to strive to overcome those things that can make us susceptible to a streak of losses. And yet again, to over-leveraging, which will surely ruin the account. First thing, over-trading. You know what over-trading is? If you have a successful streak in a day, then stop trading for that day. Don't over-trade. Don't trade every day, because every day is not for trading. You don't need to trade each day. You don't need to trade each hour. If you have a good winning trade and you see that the price is almost got the full extent of its ATR, and you know all currencies are calm or hibernating, there are no much movement, then quit. There is another day. If tomorrow is NFP, well, don't trade NFP. Why would I trade NFP? There is always tomorrow. There is always Monday, right? So if you have 5, 6, 10 winners in a row, for example, 10 wins in 2 days, then stop. Don't do any more trading, because market will get you. You know, the devil is waiting. Well, it can jump you if you don't respect the market. It will jump you. It will stab you in the back. Again, revenge trading. One of most dangerous, psychologically dangerous things in your Forex life. Revenge trading is basically a trade which is taken purely by emotions after a loss or series of losing trades. Then you want to make up for your loss as quickly as possible, and you open your trades without any strong basis for opening. Technically, you are wrong. Psychologically, you're even more wrong. You're wronger. So don't do that. Revenge trading is something you should never do. Stay out of it. You need to accept the loss. If you make 3, 4 losses in a row, stop trading for the day. Wait 1, 2, 3, 4 days, but don't try to make up for your account as quickly as possible. It can lead you to a spiral of doom, and that can be your downfall. Cut the losses short. If you see that your trade is going nowhere and you don't have your stop loss put, which you should have put it, then cut it. Just press the button. Exit out of the trade. Leave the trade. Cut the losses short. Try to let the profits run. But more important is cut the losses short. I really don't like to use big stop losses. If I do a bit of more leverage, I really try to find a good reason, and that is that means that my stop loss is not big, anywhere from 10 to 15 points. So if I see that the market is going to hit it, well, I will cut it. It's okay. If it gets hit, I will cut it. And you always need to cut the losses short. Don't pray Don't try well, to influence the stars and your religion in your trading. Try to trade without it. So if you're losing, cut it. There will be always another day. You also need to understand fundamentals. Without a proper understanding of fundamental, I'm not talking about trading fundamentals. I'm just talking about understanding fundamentals. That can be your enemy if you don't know how to trade it. That can often lead to misjudgment and loss because there is discrepancy between technical and fundamental trading. If you understand fundamentals from the strictly economical point of view, you know what you should do. Last 2 or 3 days there was an uptrend in Aussie, and it was being started by good fundamental views of Australian economic. So now last few weeks there is a strength of dollar. Why is there a dollar strength? It's because of Syria talks, right? If dollar always strengthens when there is upcoming, I can say, war or something like it, warfare. So you need to know, you need to understand the fundamentals, and then trade technically with it. The best thing is when fundamentals go along with technical views. So try to understand it. NFP is always a good thing, so it can usually determine the trend for next few weeks for euro-dollar pair. Avoid the euphoria. If you come to euphoria, you will lose. So you know when we were talking about that famous spiral, psychological spiral. Euphoria is at the top. Don't trade when you are euphoric. Try to avoid it at all costs. If you feel euphoric, close your platform and go away. Don't try to trade while you're being influenced with euphoria. That is a heightened sense of emotional state. You should avoid it if you trade. You need to stay calm. That is called trading nirvana. You need to be calm. Real life versus practice. Again, trading on live account is not as same as demo account. How to overcome that? Demo or demo account. Depends of your pronunciation. The best thing is that you trade on your demo account as you would trade on your real account. That is how I learned to trade on live account. I traded demo account same as I would trade my real account. You need to get that into your head. You need to psychologically accept the thing. It doesn't matter if you burn the account. It's just another mistake, and you will notice the mistake, and it won't happen again if you are good enough with yourself. So try to trade on demo account as the same as you would do it on your real account. Again, emotions: greed, fear, and paralyzed by analyze. Greed can lead the trader to hold on to a position too long in hopes of a higher price even as it falls. This emotion has been the main reason behind many trades that have gone from large gains to large losses. To thwart that emotion, try to take an objective look at the reasoning behind your position. When one of your positions, if you're, for example, a longer mid-term trader, and let's say that you're a longer-term trader, and your position experiences a large run-up, ask yourself whether the reasons behind your initial investment still remain. If not, it may be time to close or reduce the position. Also, greed. If you go with overtrading, don't be greedy. That is connected. Don't be greedy because you will overtrade. Fear can prevent a trader from entering trades, and usually it can lead them to taking out of positions far too early. So, if you are concerned with potential loss and the risk that comes with investment or your trading abilities, you can sometimes be dissuaded from a good opportunity, trading opportunity. If you're susceptible to fear, you may probably, enter a trade too early or exit the trade too early based on the fear of losing the gain you have made. So that is the case that prevents you from cashing in a much bigger gain. The third thing is paralyzed by analyze. That is a phenomenon where traders get so caught up in analyzing everything about a potential trade that they never actually pull the trigger on the trade. Well, it can happen if you switch, and it happened to me first time maybe some 3.5 years ago when I switched from retail trading to full investment trading. That was my the biggest, maybe, yeah, it was the biggest account in my career so far, and that was my analyses were excellent and everything, but I was a bit afraid to pull the trigger because I dealt with 10 or 15 times the money I had prior to that. So, and paralyzed by analyze. It's very, very, now of course it doesn't matter. I can deal with 10 millions if I have to. It's not a problem at all for me. But well, for new traders and for switching from retail to hedge account, you can be paralyzed by analyze. So maybe you will constantly question all of your little details found in the analysis in attempt to perfectly analyze the situation, because you're dealing with big money, with big investors. That is, believe me, an unachievable task, and that can prevent you, a trader, both from making monetary gains and from making experiential gains or good gains by getting into the trade. So a wide range of emotions can rule you, but the important thing is to recognize these emotions and to subside them, to don't let them overcome you. Again, psychologically important, knowing when to trade. I told you I don't trade on NFP days. I can trade NFP, or I can trade after the NFP, but I don't trade prior to NFP. I don't trade on bank holidays. I don't trade on days such as today when there are huge wave of fundamental releases. So you need to know when to trade. And the last thing, it's called invulnerability. That means that you are invincible, that your account is invincible, and that nothing bad can happen to you because you're a master. Believe me, you are not a master. There is always a chance that you can lose. There is always a chance that something or some fundamental action or a catastrophe, natural disaster can happen, and it can be your worst nemesis, your enemy. So you're not invulnerable, you're very vulnerable, but you need to protect yourself with good shields. Your shields are being psychologically and technically correct. With that, your chances can go to 80-20, and you can get into top league of the traders. But that requires a lot of experience, a lot of work on yourself. And then after you will recognize the moment. When you recognize the moment, you will know that you are good to trade, but never let the demon inside you never let the demon inside you to overcome you and make you again from professional trader to a newbie trader. So that is what I wanted to tell you, and that is the big truth. These things which we talk today, especially those psychological phenomena and those technicals, are the most important factor for you becoming a professional above the average trader. That is what can decide your future, whether you will be a new trader searching for Holy Grail, or you will stick to your strategy and overcome the biggest enemy, and that is yourself. I have finished.
Yeah, great stuff there. Absolutely.
Yeah. So now, if you have any questions, we can answer it.
If you recommend meditation before trading.
Why not? Well, why not? Why not? It's okay. I usually listen to my favorite music, so that is kind for my personal meditation. It's not like I'm meditating, but I can recommend everything prior to trading. Everything that can calm you down. Everything that can calm you down, everything that can relax you, well, everything. Yes. The answer is yes.
And did you see the euro dollar breaking below 131? Sean is asking.
Today.
Yeah.
I will open now my chart today. 32.20. Well, we need to see it. I think there is 20 more minutes to see if the euro dollar will fall. If it doesn't happen in next half an hour, well, I don't think so. I don't think so. Now the market is calm, and well, we need to see it. I can say we will see it in next 30 minutes. If it doesn't happen, well, I think no.
I think so.
We have double bottom there, so we have a double bottom at 31.10. So I don't see it at the moment. Well, we will see next.
Even if we break, it could be just a few pips, and then we push up again, because with NFP tomorrow, things can quiet down as well.
NFP, yes, too many fundamentals today, and again tomorrow with NFP. I won't trade prior to NFP, so I think that, well, my analysis will come after the NFP, or I can make some general views prior to NFP. I may do that, but I surely won't trade prior to NFP. Well, that is one of things that can differ you from average traders. Why would you trade when there is big uncertainty in the markets? Why would you trade? You can trade on Monday. It's in 3 days. So, what's the next target for euro? Let's say NFP first. If 31 breaks, the next target is 30.65. But we need to see the NFP first. You know, NFP can, again, we need to see the results. It can propel euro up. I don't know what will happen. That is purely fundamental view. But from technical view, if 31 happen to break and the candle closes, hourly candle closes below 31, well, 30.65 is the target. Yeah, that's for sure. Well, from my point of view, of course. But I don't think it can happen today, and we need to see tomorrow. When you enter the market, we lose 10 to 15 pips right away. It's because of the retracement. You usually enter the market. Okay, if you enter the market after a breakout, then you can make 5 to 10 pips, fast 5 to 10 pips. Or if the market starts to retrace, you will usually lose 10 to 15 pips. But usually, if you don't enter on breakouts, that is the thing what you all experience is called retracement. Retracement is the second part of the trend. There is thrust, and then there is retracement. That is a normal thing in the market. That is a normal thing in the market. It just depends of the level, of the price level you have entered. It's very hard to pick the price in the pip, but usually we allow those 10 to 15 pips of a loss. Well, if we trade, for example, hourly chart, so that is a perfectly normal thing if you are sure where to put your stop loss. So it's because of the retracement. If you lose 10 to 15 pips and then you gain, I don't know, 20 pips, that is retracement. Euro testing the bottom. Let's see, guys. I told you we will see in next 30 minutes. It's 7:15 p.m. Well, next 30 minutes, maybe next hour. But that is maybe next hour. Okay, next hour, let's say, because tomorrow is NFP. We will see that. If it doesn't happen, it won't happen. in next hour. If it happens to break 31.10, well, then it will probably test 31 level. So don't be impatient. I don't trade in these hours. I will wait for NFP to pass, or I will trade on Monday. So market, I won't chase the market. I want the market to come to me, right? So how to calculate risk when open a trade? Please example with numbers with okay, Chris, do you have an Excel spreadsheet, or we can do it in one of our next webinars?
Yeah, we could probably do that. Or basically, if you would have a quick example, if you have a 20 pip stop loss and you take 1% of a trading capital of $10,000, that would be, you want to risk 100, right? 1% of 10,000. And if you have a 20 pip stop loss, roughly speaking, you're going to take 5 minis, right? Because every mini you would be losing $20. So that would be 5 times 20 is 100.
Yeah, again, you can watch a webinar about money management. I think that we have some formulas there. So also, I think there is a formula on Admiral Market site.
Oh yeah, that's
main
a good one.
site. Yeah, I think that there is a calculator.
Yeah, we should actually. I'll show that. That's a good one.
Yeah, you can use the calculator. Yeah. Can you also provide a webinar on the use of MT4? Well, we can do that. Well, there is purely newbie webinar, but no problem. Maybe we can arrange that. So, how you can use MT4? No problems. I think.
Remember where it was?
Oh, well, not exactly, but I think maybe advanced tools down there under platforms and software, right? No, there is trade, under the trade. No, I'll go under the trade. There is a thing called Trader's Calculator. There is.
Bingo.
There is, you can use this, guys. You can use this to calculate your risk, your percent, your stop loss, right? So, but think always of your psychology. You need to be good in both things, technically and psychologically.
Good stuff there. You can see also the pips here, by the way, the spread.
Spread is great.
And
that
open
is
a demo.
one of my favorite things of my brokers. Great spreads, really. Perfect spreads. And very good commissions, yeah. Very, very good.
Got some analysis as well if you wanted to take a look at that.
Yeah, there is also my blog on Admiral Markets blog, so you can always see my analysis there, so no problem.
Monday,
okay,
Tarantula is going to be talking about momentum versus lagging indicators in fact. And then we're back with the live trading webinars, and next week we're going to be talking about characteristics of currency pairs, same time, same place.
Yeah. So guys, thank you for attending. I wish you many green pips, and well, tomorrow I will do my analysis after NFP, maybe something prior to NFP, but I will see. So be sure to like Admiral Markets on Facebook and to follow me and Chris. Free webinars Monday, Thursday, and live webinar with Chris. I wish you all green pips and good health. So guys, talk to you very, very soon.
Yeah, everyone, great weekend and good trading indeed. Cheers.
For your